if you have an expense that's used to derive income, you should be able to deduct it. Well, the government came in and basically went around those pretty tried and true proven tax concepts, and they said if you have a property with debt and it's not a new build, you can't deduct that. Thankfully, some common sense has prevailed and those rules have been repealed. And we're now back to full interest deductibility. What that also means is that we're now back to being able to do debt restructures as well.
We are back in your life, and today we have 5 hidden tax hacks most New Zealand property investors are missing. Michael is on holiday, so I have replaced him with somebody who is taller, better looking, wealthier, and just all around a better guy. Managing Director of Lighthouse Financial, Matthew Harris. Welcome.
That was an intro.
Yeah.
Mike's not going to be happy with this.
Look, Mike's not going to be happy. I did a podcast with Michaela the other day as well. Once again, Michael, just remember, this means nothing to me. You're my one and only. Matt, as the accountant around this place, it's around the time we're always thinking about tax returns. We're in a new financial year, and there's a lot of things people just don't really think about or get wrong.
Yeah, definitely. And I love taking the title of accountant if it's going to save our clients money. The rest of the time in social situations, I usually kind of shy away from it.
Yeah.
But yeah, definitely.
Why do you hide away from it in social situations? Is there a stigma?
Yeah. Have you met any accountants?
There's a reason why they sit on this side and I sit on that side of the floor.
Yeah, we're segregating you from there.
The foghorn of the office. So let's jump into it. So we've got 5 tips for property investors.
Let's go. Number
1, chattel depreciation.
Yeah, so chattel depreciation is something that is actually often overlooked by property investors, and it always surprises me that it is, because it is such a great source of deduction. So just to give a little history on New Zealand tax without ruining my chances of being invited to any other parties, depreciation is allowance for something that's reasonably expected to decline in value. That's everyday things. Chattels is everyday things in a property: carpet, curtains, light switches, and things like that. But
have I been able to depreciate my house for the last 3 or 4 years?
No, you haven't. And the reason being is exactly what I said. Depreciation is an allowance for something that's reasonably expected to decline in value. And tell me what happens to properties over time.
Well, the last 3 years it's gone down.
If we ignore the last 3 years.
Yes, goes up more than
properties go up in value. So that is actually probably not a topic for this podcast, but it is a source of confusion for clients, because you have capital items which are non-deductible, you have chattels which are deductible, and then you have repairs and maintenance which are deductible in a different way. But if we come back to chattels depreciation, it's pretty much the only non-cash expense that still exists for property investors, although we are going to cover one more today. And what happens with a chattels valuation is that a valuer, much like a property valuer, goes into the house and they take every chattel they can find in situ, and they get quite minute on this. So they light switches, blind rails, there's lots of stuff that they pull out of there and get into the report. They send the reports to your accountant, us, and we load those into your tax return. Most common depreciation method is diminishing value. Well, the most common we use. What that means is you get the higher amount of depreciation up front, and then it diminishes over time. And I won't have to tell you as a finance guy why that's important. $1 today is worth more than $1 in a year's time. So we're always trying to get the max deduction up front.
And what's the total period of time it'll depreciate over?
It will depend on the asset, on the useful life of the asset. So I would say on average, most chattels last somewhere between 5 and 7 years.
Yep.
But you get quite a bit up front. So the thing about a chattel's depreciation is they work really well in a couple of situations. New builds, just before settlement or on settlement, get that depreciation schedule, because you have a ton of chattels in a new build. Really easy identified, and none of them have any wear and tear on them. The second time that it works pretty well is if you buy an investment property, like an in situ property, before you've got the tenants in there. Where it doesn't work very well is if you've completed a big renovation. If you've done that, there's very little point in getting a chattels valuation, because you've got a list of things that are chattels that you can already depreciate. And you're going to have that a discussion with your accountant about what's capital, what's repairs and maintenance, what's a chattel. But nevertheless, you've got the list. And the other time that Inland Revenue doesn't really like it getting done is when you've had a rental property for a very long time. And it's actually not really clear why they don't like it. I think they just would prefer that if you're going to get a chattels valuation, you do it earlier on in the business operation of that property.
Yeah, cool. And I think there's an example that an $11,000 chattel valuation at 20% depreciation, there's about $2,200 of deductions in year one. That sounds pretty good to me. How much does it cost to get a chattel's valuation?
Yeah, so a chattel's valuation is about $550 plus GST. There's really only one company that does it, so I'll give them a free plug, valueit.co.nz.
Love a monopoly.
Yeah, same. Well, this is New Zealand, the country of monopolies. One airline, one train service, one government. Oh, okay.
Moving on.
But that Valueit are the only ones who really do it, as far as I know. It's about $550 last time I checked, but you get about $6,000 of tax savings over the life of a chattel's valuation. So there's only one other thing worth mentioning here before we move on to another topic, and that's if you are running a negatively geared portfolio and not a designed one. So most capital growth assets will sit somewhere around the net neutral, negative, net neutral, positive in a good interest rate environment. And so I consider that to be about 4%. We're not there yet, but we are definitely heading back there. But if you are if we get so obviously ignoring a 7% rate environment, most people are negative unless the James Blairs of the world who own all the multis.
No, we don't talk about the multis on the podcast. The cockroach, called the cockroach.
Yeah, but the reality is that most property investors don't fit into the multi-property category. They're 1 to 2 property mum and dad. They've got KiwiSaver, they've got a couple of investment properties, and they've got a shares portfolio, and that's a diversified way for them to get ahead. Most of those people, if we're at a 4%, should be at a net neutral positive. In that case, a chattel's valuation is a good thing because you're going to get some deductions over the life of the property. What's going to naturally happen is rents are going to go up and mortgage is going to go down. You're going to get those deductions. If you have a hugely negative portfolio, and you're burning $10,000, $15,000 a year, chucking another $6,000 deductions is not going to make any sense. So, like anything in tax, just ask a few questions from your accountant, crunch the numbers, and if it's worth doing, you should do it, because non-cash expenses are very hard to come by.
Nice. Well, let's move on to one that I really liked: home office expenses.
Yeah, definitely.
How does this work? What I think about my investment property on the couch while I'm watching the latest Paw Patrol episode with Cooper, therefore it is deductible?
Look, you're not far off it, surprisingly enough. So I'm going to put my tax hat on just for a little bit. The history of this is quite interesting. So Banks versus Commissioner of Inland Revenue was the test case for home office expenses, and Mr. Banks was a school teacher.
Oh, you make it sound like it's the banks versus the government.
Yeah, I know. Well, it's just the way that you say the name of the court case just sounds kind of cool.
Yeah,
Banks versus Commissioner of Inland Revenue.
I don't think that statement's ever been made before. That this court case sounds cool, but anyway, continue.
Yeah, you're right. Actually, I might be the first. So he was a school teacher, and what he did is he used to mark test results and things like that at his kitchen table. And so he put a deduction in for a portion of running his home against his income. And this was back in the times where everyone in New Zealand used to file a personal tax return. So it was, I believe, only the mid-90s where we went to the PTS system that we have now. Before that, literally every single person had to self-assess. So he's chucked this in his tax return. Inland Revenue's come across it, and they've decided to take a test case. So a test case is when the law is not clear and the government IRD decide to test the rules, and generally they'll pay for that. So they'll pay for both sides of the coin, and then they'll, depending on what answer they get, they'll take it all the way through to the High Court. And they'll try and get an answer. And it depends how passionately they feel about the subject. Anyway, long story short, Inland Revenue lost. Banks versus Commissioner of Inland Revenue set the precedent for home office expenses. So what it is basically is that if you're in business, so that's you are deriving income from services, from manufacturing, whatever it is, and you use part of your home as an office, you can claim a deduction for that. It is, and it's, whilst it's not technically a non-cash expense because you are paying your outgoings, it's as akin to it because you would have paid those outgoings anyway to live. We in this office usually take a 10% deduction, which is we just assume that most people do some work at home. You get and it's really easy: phone bill, internet, rates, insurance, interest on your loan, or if it's rent, put all that into a little calculator. 10% pops out. You put that in your return, tax deduction, and it's great because you spent that money regardless. Because you had to pay your rent or your mortgage, you had to pay your power if you wanted to be warm. But you get a deduction. If you have used it more than that, you are entitled to take a bigger deduction. It's just we would ask some questions. So, for example, some landlords would manage multi-property portfolios, and they might have a whole garage full of paint buckets and ladders and ride-on lawnmowers or whatever. And in that case, they can clearly show they deserve a bigger deduction.
Can I ask for some personalised tax advice?
I'd love to give personal tax advice online.
I run a business and I'm a property investor.
Yes.
Can I go 10 and 10 or do I only get collectively 10?
Look, that is probably the most common question I get about home office expenses. No, you can't. You can only get one deduction. Look, I'd love for you to be able to get two.
Yeah.
But to be honest, for a 10% home office expenses, there's probably bigger tax punts you could take.
Yeah, I had, I'll try and keep this vague enough, but I had somebody recently talked to me about their partner claiming massages and tickets to concerts and those sort of thing as expenses, where there is quite clearly no link to that at all. And the IRDs just started to look into it.
No.
Which would that be quite unlucky as well?
I think it would be unlucky. And the thing you have with inland revenue is that they are inland revenue, whilst it is government, is a commercial undertaking. They're mandated by the Tax Administration Act to collect the highest net revenue over time. And what that means is that if there's two people to audit and one is likely to get a big tax discrepancy, it's called $50,000 versus someone who's claimed massages and maybe they've got away with $1,000 or $2,000. Well, they're going to go the $50,000 all day long because they are trying to get a rate of return for government and meet their obligations. So it is quite unlucky, and it's going to be a pretty easy case for them because the nexus with income is basically a rule that determines deductions. If you can have a deduction if it is has a connection to your income earning activity. I know Robin Sharma, who's a motivational guy I follow, bangs on all the time about 2 massages a week, really good for mental clarity, but I think it's a pretty long stretch to get that to a tax deduction.
Yeah. What if you're thinking about work while getting a massage? Let's move on to the next one, which is one of my personal favorites, and one thing that we're talking to a lot of clients about, the clients aren't aware about it: debt restructuring via LTCs.
Yes. Yep. So this is one of my personal favorites as well, and it's
can be very material. Like we can be talking about tens of thousands in a year, and potentially over a period of time, 6 figures.
Yeah, definitely. So to start the conversation, my first thing I'd note is that I think property investors, by and large, should use professional structures. Limited liability, separate legal entity, professionalism, and if you're going to do property seriously, you need to take it seriously. So that's one good reason to look at restructuring. When we look at LTCs specifically in debt restructuring, there's an interesting history here, where we used to do lots of this type of work, and so to set the scene for the common scenario, James has a investment, so has an owner-occupied property. He's been living there for 4 or 5 years. He's managed to pay down a chunk of debt on that property, and also the property has gone through a nice cycle of upward growth. So
nice.
It would be nice if it's coming back. Don't worry, all you property investors, we're getting close to being back on again. It's like when the crypto goes up, you won't not hear of it from us. So James is sitting on a nice $1 million value property now, and he's got $500,000 in mortgage. So big gap there. He then does what a lot of people do, which is he decides that he wants to buy a new house. He's going through his journey and maybe Coops needs some more room. Yep.
Second baby on the way.
Yeah.
Got to get an extra bedroom.
Things are heating up. So you go and buy a new house and you spend $1.5 million, let's say. And you do what a lot of people also do, which is leave their former owner-occupied house as an investment. So what's going to happen is, let's assume that you use 100% leverage to buy your new house. So you use all the equity, your $500,000 equity, and you buy this new house. You end up with a very tax inefficient structure for debt purposes. And the reason being is your new owner-occupied house has $1.5 million of debt on it because you've 100% leveraged it. That is non-deductible. Your investment property is $500,000 of debt on it, which is deductible. In totality, you've got 2 houses worth $2.5 million and you've got $2 million of debt. It's a very simple restructure that we do. What we do is we take that former owner-occupied property, we transfer it into a look-through company at market value. $1 million. We then go to the bank and we borrow $1 million against that property and put it against the owner-occupied property. So all we've done is you've got the same 2 properties still, you've still got the same amount of debt, but on the investment, you've got $1 million of tax deductible, and then you've got the balance on your owner-occupied non-tax deductible. And on $500,000 of debt, on a 4.5% interest rate, you're probably looking at something around the $25,000 to $30,000.
As soon as you said 4.5%, I was like, you're making this math harder for you than it needs to be.
Yeah, I know. What I'm doing is visualizing the rates I want to see in the next month or two. We've got a 4.77 floating out in the market 1 year at ASB at the moment. Things are heating up.
SBS is doing a 3.99 for first home buyers, like back my build.
Yep. Seen that. And I think ANZ's trying to match something similar for first home buyers or new builds. So either way, you're looking at, so forget the math, substantial deductions and no difference in your financial situation because you have the same 2 properties with the same amount of debt. And so this has come back around. So we used to do this lots, and then we had interest deductibility rules come in. And those interest deductibility rules did something quite uneconomic. And remember how I said before about the connection with income? If you have an expense that's used to derive income, you should be able to deduct it. Well, the government came in and basically went around those pretty tried and true proven tax concepts. And they said, if you have a property with debt and it's not a new build, you can't deduct that. Thankfully, some common sense has prevailed and those rules have been repealed. And we're now back to full interest deductibility. What that also means is that we're now back to being able to do debt restructures as well. So if you're out there and this sounds anything like you, definitely get in touch with us because you'll be surprised the magic that we work here. And at the moment, because the rates are coming down, the banks are also in a bit of a giving mood. So we've seen lots of cash back and stuff like that getting negotiated as part of these kind of deals. So
you got a little bit of magic in you, do you? A little Expelliarmus.
Yeah.
Yeah.
You're a wizard, Harry.
Yeah. There's that puppet like YouTube thing from back in the day. And it's like Harry Potter, Hermione. Okay, well, Harry Potter jokes aside.
I enjoyed that.
The next one that we see all the time is, Matt, it's great if I can take my family to Disney and it's a tax deductible expense. So I want to talk about travel deductions and we'll do that after this break.
The marketing team here at Lighthouse wanted me to promote Lighthouse Accounting. You might have heard about the best property accountants in New Zealand. I'm not going to do that though. We are having a webinar to discuss all the tax deductions that you should be getting. 2nd September, 12 p.m. Join me and I'll break down all the deductions to make sure that you're optimizing your portfolio. Now, back to the episode.
Okay, so Matt, travel deductions. You must get asked about this all the time.
Travel deductions, you shall not pass. Now I've got Lord of the Rings in there as well.
Yeah. My precious tax deductions.
Yeah. My precious.
Wait, that's something like Elmo with. It got a bit weird, eh?
Travel expenses. Look, difficult area. And we get a lot of questions about this. Disneyland's not far off the usual context. So travel expenses are quite difficult. So there are some circumstances where it's really clear that you've incurred travel costs that are going to be deductible. An example would be I am a property investor. I'm domiciled in Auckland, but my investments are in Wellington. I've got to travel down and do an inspection, carry out some repairs, et cetera, et cetera. I travel down by myself. I do those repairs. I might stay one night and then I come home. That's quite clearly connected to your income earning process and most likely nearly 100% deductible. There's always some areas that are not deductible, like a private meal at night, for example. But more or less, we can look at that and objectively go, yeah, that was deductible. Where it gets more complicated is if you're traveling with others, most commonly spouse or children. Obviously, unless your spouse is heavily involved in the portfolio, which that can be the case, and you go down together and do that and you do nothing else, that's probably still deductible. But the moment you start doing other things on that trip, it gets pretty murky.
Just be cool. Why just let people deduct their stuff?
Oh, look, I'm a pretty good guy. I'll let
You're
you
a cool
deduct.
guy?
Yeah, if you can prove that you deserve it, you can have it. But unfortunately, the tax rules don't really work like that. So our job is to maximize our client's position as much as possible, but not get them in trouble either.
Yep.
So sometimes we just have to have a bit of a discussion about what the purpose of the trip is. And for example, people might go overseas to conferences. They might take their family. The family might break away and go do a week at Disneyland. They'll do a week at the conference. You just have to split the costs and be reasonable about it. And that's all that travel deductions comes down to. It's being reasonable because there's always going to be an argument either way that something's deductible or not deductible. But if you're just going on holiday to Europe and you're not doing any work at all, even if you take your laptop and do a few emails, that doesn't count.
Maybe I should start chucking on a conference onto my
Mate,
family holidays.
Just do a podcast every day.
Yeah. That's a good idea.
Yeah.
Em's keen. Okay, last one is professional fees. What do we think?
I think that if like anything in life, if you want to do better, you need to get other people around you that know what they're doing. And if you're a property investor or a business person, for example, as you grow in that journey and you get more success and expand, you get people like that around you automatically. But when you're starting out and in the first few years or you're not growing actively, you have to basically look to professionals who are paid to help you. So when it comes to professional fees, I definitely believe that not all professionals are ranked equally and that you pay for what you get. And that doesn't mean you should go somewhere where people like charge an exorbitant amount of money, but you should be going somewhere where if you pay a fee, you get what you paid for. And then I think bonus points, if you can work with advisors, free plug here for Lighthouse, who do the same things that you want to do.
So I had somebody sign up for a financial plan just the other day because of the multis that we're doing and going, you're doing more complicated stuff than we're doing and we get a financial plan. Let's rock and roll. On like the fees bit as well, like obviously the more time you do this and you're giving advice and like say for a financial plan, we charge $3,000 plus just and they're like a little bit pricey, eh? And they go, should I like go talk to somebody else? And I was like, well, I mean, you can go get the Toyota if you want, or you can have the Ferrari. It's your call.
Yeah, definitely. And
I did just call myself a Ferrari.
Yeah, you did. I think probably like maybe Porsche. Like, let's not get ahead of ourselves. But there's that old adage that price is only a problem if value is absent. And I think if first of all, if you're dealing with a professional who knows what they're doing, there's value. Secondly, if they're doing the things that you want to be doing yourself, there's extra value.
Ilsa Wolf is a perfect example. Ilsa Wolf is expensive without understanding the value that she adds. But as soon as you understand the size of the widget and the amount of stories I've seen with property investors trying to do what Ilsa does by themselves, like just pay the fee.
Yeah, because there's experience. There's heaps of little analogies of this out in the marketplace where the plumber shows up and like bangs the pipe and it's just unblocked and he sends an invoice and it's like $10 for travel and $500 for the experience. You know, like there's nothing true. And when you are utilizing professionals, they have undertaken years of study, they've been on the ground doing work and they can just do something so much easier than you and save you so much time and money. And it's even like I come across people who want to do their own tax returns. I'm not offended by that, but I don't even waste time doing my own tax returns because I've got more valuable things to be doing with my time. So there's also that equation as well.
Yeah. Have you ever seen a real estate agent, like somebody selling have you been to an open home where somebody is selling their own home?
Yeah.
It's funny, isn't it?
And it's how much money they're leaving on the table. Because a good real estate agent will go and push the price up, will get multiple offers. And that's one part of it. And the other part is they'll just make it a hell of a lot easier for you. Take away the emotion.
Yeah, the emotional bit. Knowing how to manage these other offers opposed to you're thinking, I need to go on to do the next thing.
Exactly. So
these
in
are
summary,
all deductible?
Pay them.
And these are all deductible expenses.
Professional fees by and large are 100% deductible.
What are your thoughts on a financial plan? Is that tax deductible?
I don't believe it depends on the context of the financial plan, but I think that's probably a capital expense for an individual because it's part of the wealth producing structure.
What if it's like repairs and maintenance to their financial position?
I honestly, I would say that whilst the financial plan itself is not tax deductible, probably the ongoing reviews would be, as long as there's income coming out of the portfolio that put them in.
That may be the most nerdy thing I've ever said, by the way.
Well, because you think about it, right? Like if I've got a share portfolio, I can deduct the management fees.
Yep.
What's the difference?
So, for example, the professional fees, you've got like $2,500 in accounting fees, $3,000 in property management, a $500 valuation. That's $6,000 in deductibles.
Yeah.
That's a lot of money.
Yeah, it is. And with all this stuff, no one wants to pay any more tax than they have to under the law. And if you get that equation right, any tax that you don't pay can be reinvested into growth assets, and effectively, incrementally over time, if you do that year after year after year, your wealth grows and grows and grows and grows as a result of it. It should be one of the top priorities for property investors, for business people, and even for individuals. So since we moved to the PTS system, there's been very few deductions available for salary and wage earners, but there is some. Loss of earnings insurance, which is if you have a family, if you have and a mortgage, a family, a mortgage and investment properties, or anything that relies on your income, you should have loss of earnings insurance.
Income protection.
Yeah, income protection. It is, dare I say, irresponsible if you are a parent out there and you've got people that rely on you, you haven't done that. So if that is you, come and see us. Don't worry, we won't make it expensive. That's deductible. Interest on money borrowed to invest, and accounting fees. Yeah.
Okay, so there are your 5 tips for those property investors out there, how to make it more tax efficient. Just if Michael is watching, just remember, Mike, this means nothing to me. Can't wait for you to get home. Much love to Lighthouse Financial for sponsoring this episode. Please subscribe to our channel, give us a review, give us a like, and we'll catch you next time.
Cheers.